Welcome back to Talk Tickers. This is the deep dive for the professional investor, the place where we strip away the IR fluff and get straight to the P&L. I'm your host, and today we are breaking down West Bancorp, ticker EWBC.
It's great to be here. And we are dissecting the Q4 2025 print, which hit the wires on the afternoon of January 22nd.
And what a fascinating, really conflicting print this was. We have a classic setup here. On one hand, you have management taking a victory lap record revenue, record earnings, and a dividend hike that, frankly, you don't see very often.
A 33% increase. That's not a typo.
Exactly. A massive signal of confidence. But then you look at the tape.
Yeah, the tape tells a different story.
The stock drops 2% after hours. It trades down sharply the next day on heavy volume. So the mission for this deep dive is simple. Why did the market sell the best year ever?
Right. Is this just good news priced in, or is there something else going on?
Or is there something in that 2026 guidance that gave the street, a severe case of indigestion?
I think it's a bit of both, but mostly the indigestion part. This is really a story about the tension between pristine capital management and the harsh reality of operating in a falling rate environment.
It's that strength plus realism narrative you mentioned.
Right. Exactly. The strength is undeniable, but the realism about future expenses and credit costs is what spooked the traders.
Okay, let's unpack the headline numbers first. Before we get to the scary stuff, we have to acknowledge the beat, because on paper, this looked perfect.
It was a very clean beat. GAAP EPS came in at $2.55.
Netting out to what, about $356 million?
$356 million in income, yeah. On an adjusted basis, that's $2.52 per share, which beat consensus by 2 pennies.
And revenue.
Revenue is roughly $758 million, which beat the street by about $10 million or so. So a top and bottom line beat.
A double beat. That usually gets you a green arrow on the screen. But I want to pause on what I call the shareholder candy, that dividend.
Oh.
A 33% hike isn't just a nice to have. It is a statement.
It is a massive statement. The board declared a quarterly dividend of 80 cents per share. That's up 20 cents.
Right.
When a bank CEO does that, they're explicitly telling you they have nowhere else to put the money that would generate a better return.
So this Dominic Ng, the CEO, basically standing on the table and yelling, "We are overcapitalized."
He essentially is. And the metrics absolutely back him up. Their common equity tier 1 ratio, the CET1, is sitting at a fortress-like 15.1%.
Okay, let's contextualize that for you listeners. 15.1%. The regulatory minimums are vastly lower.
Oh, way lower.
Most regional banks are happy sitting at, what, 10 or 11%?
Correct. 15% is incredibly high. It means for every dollar of risk-weighted assets, they hold 15 cents of core equity capital. It's a huge safety buffer.
It basically makes the bank bulletproof.
To standard economic shocks, yes. But it also drags down return on equity if you don't deploy it.
Which explains the dividend hike. They're almost forced to give it back. It's burning a hole in their pocket.
And yet, even with all that excess capital, their performance is still there. Tangible book value per share grew 17% in 2025.
And tangible book value, just to be clear, is the metric that value investors really live and die by.
Exactly. It's the breakup value of the bank. And to grow that by 17% in a single year is a massive compounding engine.
So, on paper, pristine beat, huge raise on capital returns, a bank growing book value at 17%, paying you more to wait. So why the long face from the market? Let's get into the P&L and margins. I think the devil is in the details here.
It starts with net interest income, or NII. That hit $658 million for the quarter.
With the net interest margin, or NIs, holding pretty steady.
Yeah, holding at 3.41%. Now, here is where it gets technically interesting. East West has flipped its sensitivity profile.
I noticed that. Usually when rates get cut, banks complain, right? Their asset yields drop faster than their deposit costs. But management here noted a benefit.
Correct. In the very short term, they are liability sensitive. The December rate cut actually helped their Q4 numbers because their funding got cheaper immediately.
And this brings us to the big buzzword of the cycle, deposit beta.
The single most important metric right now, it measures how much of a change in market rates gets passed on to your depositors.
And East West is executing this beautifully.
Better than most. Since the Fed started cutting, they've lowered their interest-bearing deposit costs by about 105 basis points.
Which gives you a beta of what, around 60%?
A downcycle beta of roughly 0.6. Yeah, that is excellent execution. It means they aren't just at the mercy of the Fed, they are actively managing their funding costs down.
And this was while they were growing deposits.
Yep, grew deposits by nearly $4 billion year over year. That's a 6.2% increase.
And the mix was interesting, too. They mentioned an inflection point with their non-interest-bearing deposits.
A very healthy sign. Those are the best, cheapest deposits. They ticked up to 25% of the total. It suggests that cash sorting headwind is starting to fade.
But, and this is the big but the market saw, this liability sensitivity is a short-term sugar high.
Precisely. Management was very clear that as we get deeper into 2026, the asset sensitivity kicks back in.
So as those loans reprice lower, that 3.41% margin gets harder to hold.
Much harder. The seesaw tips the other way.
Which brings us to their fee income strategy. If your lending spread is getting squeezed, you have to make money somewhere else.
And that's the pivot. Fee income grew 12% in 2025. Wealth management, FX. For 2026, the explicit goal is for fee income to grow faster than the balance sheet.
Okay, so they're pivoting, but they're still a bank. They still lend. Let's talk balance sheet and the credit outlook. They guided for 5 to 7% loan growth.
A reasonable target, driven mostly by C&I and residential mortgage.
I want to zoom in on commercial real estate, CRE, the boogeyman for regional banks.
Right.
Dominic Ng has some interesting comments here. He basically said they're waiting for the right price.
He mentioned that with short-term rates approaching a low 3 handle, they expect CRE to pick up. But the key phrase was their focus on savvy operators.
Savvy operators.
Yeah.
Which sounds a bit like code for our rich friends we've known forever.
In a way, it is. It means they aren't chasing new deals from strangers. They're lending to people who've survived multiple cycles. It's relationship banking.
But let's get to the bear case, because this is definitely why the stock sold off. Credit normalization.
This is the reality check. In 2025, their net charge-offs, NCOs, were tiny. 11 basis points for the year. That's basically zero.
You can't run a bank with zero losses forever, right? It means you aren't taking enough risk.
Exactly. So for 2026, they're guiding for NCOs to jump to 20 to 30 basis points.
Whoa. Okay, let's pause there. If you're a trader and you see a line item for credit costs that's set to double or triple.
It looks bad in percentage terms, absolutely. But you have to contextualize it. 20 to 30 basis points is still historically very, very low.
But the market hates the word normalization.
It hates it. But East West increased their allowance for credit losses to $810 million. They're saying, we see some specific credits turning, but there's no systemic issue.
So they're preparing for rain, not a hurricane.
Exactly. But combine that with the next topic, and you can see why the market got nervous.
The expense controversy. This, to me, felt like the main event.
It was the headline grabber for the pessimists, for sure. Operating non-interest expense is guided to grow 7 to 9% in 2026.
Ouch. In a year where your lending spreads are compressing, you're going to jack up spending by high single digits.
That's the friction. The drivers are headcount, IT, consulting, all the investment items.
And the CFO tried to defend it. She basically said, trust us, we know how to get a return on our spending.
And historically, she's right. Their track record is there. But the market operates on a what have you done for me lately timeline.
It's that concept of negative operating leverage.
Exactly. You want revenue to grow faster than expenses. When investors see guidance for 5 to 7% revenue growth, but 7 to 9% expense growth,
they see the jaws closing.
The jaws, I love that term. That shark mouth closes on your profits. That's what the algos saw, and that's why they sold.
And it signals potential margin pressure in a really big way.
Right. So let's put this into the wider investor context. East West is positioning for modest growth and some rate cuts, the consensus soft landing view.
But the stock had already done really well, right? It had outperformed its peers.
It had. It beat the financials ETF, XLF, and the regional bank ETF, KRE, over the last year. So this was a classic sell the news event.
The stock was priced for perfection.
And you cannot guide to negative operating leverage when you're priced for perfection. Even if it's for the right long-term reasons, you're going to take a hit.
It feels like the market is just saying, love the capital, love the dividend, hate the expense guide, call us when you cut costs.
Precisely. They're discounting 2026 earnings power because they fear those expenses will be sticky.
So what does this all mean for someone looking at the ticker today? The stock is down, the dividend yield is way up. Is it an opportunity or a trap?
Well, it depends on your time horizon. If you're a trader, that expense guide is a wet blanket for a few quarters. But if you're a long-term allocator...
Hold that thought, because this leads us perfectly into our favorite segment.
I have a feeling I know where this is going.
I think you do. It's time for This is Not Financial Advice.
Disclaimer time. We are not financial advisors. This is not a recommendation. Do your own due diligence.
Okay, here's the pitch. I'm calling it the Fortress Balance Sheet Dispersion Trade.
All right, let's hear it.
The trade is long EWBC, short KRE.
The regional banking ETF. Okay, walk me through the logic.
It's a quality over beta play. You go long east-west to capture that massive dividend yield. You're getting paid to wait. You're buying a bank with a 15% CET1 that just screamed, we have too much capital.
And the short KRE leg?
You short KRE to hedge out the general sector risk. The whole sector is facing spread compression and regulatory headaches. KRE is full of banks that do not have a 15% CET1 ratio.
So you're isolating the specific alpha of east-west while hedging out the sector beta.
Exactly. And here's the outrageous kicker. I'm betting Dominic Ng's dividend hike is a flex, but it's also a floor.
Oh, so...
He knows the stock might lag on this expense news, but he also said the buyback is opportunistic. With 15% CET1, they have a ton of dry powder. If this stock stays depressed because traders are worried about a few basis points of credit cost, the buyback machine will just turn on.
That's a very fair point. They can aggressively support the stock price. Most banks in KRE can't do that. They're playing defense. East-West can play offense.
You are buying a 17% ROE machine at a discount because the market is focused on an expense line. It's a capital return arbitrage.
It's a compelling thesis. But to play devil's advocate, it relies on their credit staying superior. If their normalization turns into something worse, the trade falls apart.
True. But betting against this team on credit has been a losing trade for a decade.
The track record is definitely there.
So let's recap this deep dive. West Bancorp posted a solid Q4 beat and a massive dividend hike.
But the 2026 guidance on expense growth and normalizing credit costs completely soured the mood.
The market reaction was swift, suggesting a sell the news dynamic and a real fear of margin compression.
But the fundamentals, the capital ratios, the management team, they all remain rock solid.
Final thought for you to chew on. Is this a broken stock or just a prudent management team taking its medicine early? The market says sell, but that dividend says buy. It's up to you to decide who is right.
And remember, in banking, the expense line is painful today, but the credit line is what kills you tomorrow. East-West seems to be managing tomorrow very, very well.
Well said. Thanks for listening to Talk Tickers. We'll see you at the next earnings print. Goodbye.